we are witnessing right now falling bond yields. Now to understand bond yields, let us understand what is a bond in the very first instance. See, the government needs money to carry out infrastructure activities such as building roads, colleges, schools, right? So let us take an example where the government in a city is trying to build a new school, and say the government right now does not have money, so it is asking for the people to give say 100 rupees for 10 years, right? And in return the government will be giving say a 4% coupon. Now this coupon will be given at every 1, 2, 3, 4 up to the 10th year. That means at every year it will be giving 4 rupees, 4 rupees, 4 rupees to you as an investor who will be investing in this bond. So the government with your money can build a school and you can gain from these coupon rates. Now who can issue bonds? A corporate company can issue bonds. A municipal body can issue bonds. Treasury bonds means the government, the central government bonds, which are one of the form of bonds issued in the US, because it is known by treasury bonds in US. It is known as gilt securities in the UK. It is known as government securities, a GSEC in India. And also we have junk bonds and bond funds, right? Then it is understandable that the government is using these resources to invest in various governmental acts. Now we have to understand what is a bond yield. Now imagine that there is a 10-year bond yield and the price of bond is 100 rupees. This is the price, and the coupon rate is 5 rupees, right? Here we have to understand that this is a government bond, and we know that in government people trust. If we compare this government bond to a private bond, people will be trusting the government always, because the government is there to stay forever. So people will be assured that the people will be getting the 100 rupees back after some years. That is not the same with the private company, because private company are not too much certain with their profits, with their business plans, with their governance. So people will be always ready to invest in the government of the day. Now say that the economic growth is slowing down in the economy due to the non-performance of some companies. Now what will people do? People will be withdrawing all their money from the private companies and investing them in the government bonds. So in essence I can say that demand for government bonds will increase. Now when demand for government bond increase, the price of bonds increase. So from 100 rupees the price will be getting to 101 rupees, right? But we can see that the coupon rate that we get is still at 5 rupees. That is, every year we will be getting 5 rupees up to say whatever duration the bond is for. But now since the price has gone up, right? Since the price has gone up, can we find the effective interest rate right now? If we can see, the effective interest rate has reduced, or say the yield has reduced because the prices have gone up. Because say the people are buying the bond for 101 rupees and they are getting 105 rupees after 1 year, right? But the person who has bought 100 rupees initially, he is getting 105 rupees, so profit of 5 rupees margin. Here the profit margin is only 4, because now the person is buying the bonds at higher prices. So the effective yield reduced. So that is why we say when price rises, bond yields fall. So this is the indirect relation between price and bonds. And recently we are seeing that the yield on benchmark 10-year government securities in India, it is falling from 6.9, right? It has fallen to around 6.9 from 7.4%. Right? The exact details are not needed, but let us understand what are the factors impacting. The factors impacting, one of the factors is inflation, because in inflation prices rise, and we have seen when prices rise, yields fall. Then we can understand that when yields fall, people are buying more government bonds, right? People are buying more and more government bonds, correct? Then what is the link between interest rate and bond yields? Now say, we have to understand that when the bond was at 100 rupees, the coupon rate was 5 rupees, right? Now, so we can say kind of the interest rate is 5% and the yield is also 5% here. Now when the price of bond has risen to 101 rupees, right? Now what I will be getting? I will be getting only 4 rupees extra, right? Because the coupon payment is fixed at 5, but extra I will be getting 4. So we can say the yield has fallen, right? And the interest rate has also fallen. So yield, so when prices increase, yield decrease, interest rates also decrease. And suppose when we compare stock markets and bond, we have to understand that there are both corporate bonds and government bonds. Say when the government bonds, we have to understand, say when bonds or say government bonds yield go up, people or investors pull their investment from stocks and they invest here, right? So people try to invest in government bonds because government bonds prices are getting higher, right? And the economy perhaps is slowing down. So people will be not very much interested to invest in companies, rather they will be interested to invest in the government of the day, right? So we can say when government bond yields increase, right, equity returns decrease because equity is private. So people are not interested in corporate anymore, they are interested in government, right? So we have to understand this accordingly. Finally, we have to understand what is the impact of bond yield on borrowing cost. Now for example, say the prices of bond have increased at 101 rupees. Now say the interest rates we have said declined. Now say tomorrow the government again wants money. So the governments have to give higher interest rates right now, right? Because see, out of 101 rupees, if we factor additional 5%, right? If we factor additional 5%, this has to be higher than 105 rupees. Correct? This has to be higher than 105 rupees. So that means at a time when government bond was 100 rupees, I can easily give 5% interest rate. But now, since the price is at 101 rupees, I have to give more than 5%. So now the government in, this situation when bond yields are high, the government needs to give, or say RBI needs to give higher bond yields, right? Now also we have to understand that when as government borrowing costs are high, so the benchmark rates such as repo rates will be also higher. Now finally, what is the rate of the government bonds on the FPI or foreign investors? Now say we are comparing the US government bond yields with the Indian government bond yields. Now you say me that when bonds yields rise in the US, right? When the bond yield rise in US, these foreign investors who are present everywhere across the world, they will be obviously interested in the US. Say if any foreign investor is in the Indian government bonds, they will be withdrawing all the Indian rupee and they will be going out to US to invest their money because they are getting higher returns in the US. So when bond yields increase, FPIs or all the foreign investors in India, they pull out money. They pull out money from Indian markets and all the money goes to the US in their government bonds, right? So this was the comparison.